Great, so sounds good. Hopefully you can see my desktop. And I'm just starting with this slide because I need to just run through our disclosures quickly. This webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussions of a particular market or product herein should not be construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. The presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. It will include references to actual past trading results for discussion purposes. But remember, guys, past results, they're not necessarily indicative of future results. And increasing your leverage does increase your risk. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss and not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act. And contracts for difference, otherwise known as CFDs, they're not available for US clients due to regulatory reasons. Okay, guys, that is that. Let me just pull up my charts. This is what a Bloomberg terminal looks like. I'm sure some of you have seen it. But on this note, this is a good place to start, actually. Obviously, it's been quite a momentous 24 hours for the UK, new heir to the throne and all that. And interesting enough, about the same time as the news broke, or as the child was born, I should say, at about 4:30 in the afternoon, we've actually seen sterling really stall since then. This is a daily chart of the pound, and I'm just writing a note now, and it's kind of interesting to me because, it wasn't that long ago that people were really calling that sterling deserved a giant pounding, that it was going to be, whipping through the 140 level, getting down to kind of, sub 145. Well, it really hasn't done that. And, we've actually seen quite a powerful recovery. Now we're through, some major levels. We got through the 200-day moving average yesterday, through the 50 and the 55 days. So a cluster of daily moving averages. We shot through there yesterday, but we are running into some key levels of resistance. No surprise really. Yesterday, if you actually looked at like a volatility chart of sterling, of cable, you would have seen it really spiked higher, and it broke out of its trading range. You can see that you don't even need a volatility chart. You can see that just by the length of that candle. And so when that tends to happen, it happens actually quite a lot. It happens quite a lot in sterling, but when it happens, you then kind of tail off a little bit. So this tailing off is perfectly normal and does not suggest that, this 154 level is necessarily the high. We think there could be a few other things that may determine that. But as you can see, this just below 154, massive level. Not only is it the 61.8% retracement of this down move here from kind of mid-June to early July, but let me bring up my other chart, bear with me, and you'll see just how important it is. I know some of you who follow me a lot will know that I love a good Ichimoku cloud, and here you go. It is the Ichimoku cloud, and this is one of the reasons why I like them. They do tend to work. The markets, large scale, the thing about technical analysis, there's lots of indicators. And, when you've got lots of indicators, you get tons of levels, and sometimes those levels mean nothing. The one thing I like about the Ichimoku cloud is that a lot of is that they're quite popular in the market, so they, the levels are respected. So this 154 level is really attracting, it really has been attracting a lot of buying interest, or selling interest, or taking profit interest is what I should say. And that has, that corresponds to the bottom of that cloud. Now, remember with these, clouds, what you see is that, but anything below the cloud is downtrend, technical downtrend. Above the cloud, is a technical uptrend. So when you get a break above the base of that cloud, it's just the end of your technical downtrend. So it's a significant level. It's a real kind of change of paradigm maybe for the pound. So it's no wonder that it's been a bit torturous for the pound at this level, because people are willing to sell on any rally. So they're selling at these big resistance levels, such as that 154 level. If we can break above there, then it opens the way to 155. The one thing I'd say, the top of the cloud, obviously, so the orange line here, that comes in at 154. 74. So that again could attract some selling interest, a bit of hesitation as well. The other thing, obviously, that we would that we would point out with sterling, and this is something that's been interesting development actually over the last few weeks. Do you remember at the beginning of July we saw that sell-off? Beginning of July, it was around about here, big sell-off in the pound in cable, and that came on the back of a statement from the Bank of England, first meeting under new Governor Mark Carney, and he said, not so impressed by the growth, forward guidance, and that caused a huge sell-off. Well, if you look just here, you're getting the opposite type of move. That was after the minutes came out and no one voted for more QE, and the minutes were perceived as being maybe slightly more upbeat than some had expected, maybe slightly more hawkish. So you basically got, from the same meeting, the statement and the minutes giving exactly opposite market reactions. So that is that's a very interesting development there. And I think what it suggests is that no wonder to me people are booking profits in the pound at any kind of major resistance level, because what it suggests to me is that the market are confused, and that the Bank of England could essentially wrong foot the UK, the sterling traders yet again. Are they, at their next meeting in August, at the inflation report, are they going to take the same tone, the dovish tone of the statement, or are they going to take the more hawkish tone of the minute? So we're very much kind of, it's an open door really. There's a lot of uncertainty there. So it doesn't surprise me that we are running into some resistance here. But obviously the pound isn't it's not because of the Bank of England. It's the only reason why cable has been moving. Cable's also been moving because of this. Oh, yeah. This is the dollar index. As you can see, it's been battered. It really has taken a right beating the last couple of weeks. Obviously, we had that testimony from Bernanke last week to Congress, and that was perceived as being very dovish. He did a fantastic turn of oratory, if you like. Really, these central bankers are the new orators of our age. It's not future kings or even prime ministers anymore. It's Draghi, it's Bernanke, it's maybe Carney whenever he gets a chance to talk, probably the next inflation report. But he has managed to do a very fantastic thing. He has managed to tell the markets that yes, we're going to be tapering, but you don't need to worry, because we're going to keep policy very loose, and we're only going to be tapering some of our asset purchases. They're still buying, so don't worry about it. And the market hasn't worried about it. As you can see, dollar's sold off. Remember, the dollar tends to sell off on the back of QE. And that sell-off, it wasn't that long ago that we were near 85. We're now at 82, or just kind of hovering around about that 82 level. That's acting as very good support, but it's not helping. Sound has been lost. Can everyone hear me? Can someone just... I don't believe sound has been... Oh, no. Sound is fine. Sorry, Ray, you may have just got your own problem. Okay, brilliant. Thanks, everyone. Check your own issue if sound has been lost. Let's just see. So we've, as I can say, the dollar really has kind of sold off, and that's been another driver of that move higher in the pound. So, as I said, he's done a fantastic job of being able to manage market expectations about that and really calm the market when it comes to tapering. That's been reflected in this week's dollar, but it's also been reflected in this. The S&P 500, very, very close to those record highs now. We made another one yesterday. Very close, I should say. We continue to make them. We are making record highs left, right, and centre. Yes, if you look, the movements in something like the S&P 500 have been much more slight than they have been, say, in something like cable. But you do expect that when you get to these record highs. So obviously 1700, massive level. The high yesterday, 1697. So very, very psychological level. Obviously a complete record high. We've had some spikes here in volume as well. It's quite good news considering the markets have generally moved higher on kind of fairly low volume, but certainly no volume drop off, even though we're in the summer months. It'd be interesting to see how that works out. But again, as we said, the next major event for the US is going to be those payrolls a week on Friday. that is going to be the key thing that drives stocks, that drives the dollar, because, you know, the Bernanke also left things very open. They said, you know what, added to that, our tapering will be data dependent. One of the key things about the data, one of the key things, about tapering is that we've got two more non-farm payrolls reports before the September Fed meeting, which is going to be a huge meeting. Everyone's eyes are going to be on it. It's going to be taper fever. Oh, very good. I'm glad your internet connection's back. That's fantastic. You can join in. But it does mean that these two reports, the one for July and the one for August, are going to be really, really pivotal for markets and determine direction. So as I said, you know, S&P 500 could grind higher. As I said, 1700, I wouldn't be surprised if people took some profit at these levels. But then, you know, the real kind of directional move, whether or not we go higher or really shoot higher, or if we make a complete reversal, will be dependent on, you know, the July payrolls data. And, you know, so far we've seen some fairly mixed data actually on that front. We obviously haven't got some of the we've got to wait till next week to get some of the key drivers of the NFPs. Not only we've got to wait till next week, get the ISM reports and what they're saying. The ADP report, things like that. But right now it looks like, you know, the S&P can potentially grind higher. Now, obviously this is, you know, what this shows you, and these kind of record highs in the S&P show you, is that we're actually in an environment whereby risk is quite friendly to risk. You're seeing that as well in Euro. As you can see, Euro above this cluster of daily moving averages. I think last week we were talking about that cap and gains. Well, you know, they didn't shot right through there. Interestingly enough, though, the moving averages, they've kind of flattened a little bit, which suggests, which is not surprising ahead of 132. It is a very big resistance level anyway. Now, those of you who followed my webinars for a while now will know that in the past I've spoken about how the euro tends to move in a range. It's an interesting thing. It does tend to move in a range. It's probably a mixture of the fact that it's the second most widely traded currency in the world. Also the fact that you've got lots and lots of different economic data from 17 member states to digest. That could be some of the main reasons why it does this. So, in the past or earlier this year, that range was kind of 128 to 132. We think we could be maybe trading in that range again. Now, obviously, there is a risk that we break out of 132 and get to 134. That was the high from middle of June. But we would, that's a lovely double top there that could really stimulate the bulls in the medium term. But we wouldn't be surprised if we do take profit from here. Now, as I said, very, very good support. That 200-day moving average, 130.80, is kind of your near to medium-ish term support now. And, you know, a lot of people are looking to buy, or what we've heard anyway, is that there is some buying interest around about that 131.50, 30 to 50 in the very, very short term, looking for a move above 132. However, we know that there's a lot of stop action going on at about 130.80. So people are looking for that to hold as good support, so that the range could narrow. That would be quite normal to do over the summer as well. Remember, August, we're only a few days away from August now, really. But that's when Europe really tends to shut down. So after that ECB meeting at the beginning of August, things could get very quiet for the euro and could range trade. Now, some people get scared about range trading. They're like, oh, I hate it, no volatility, la 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 la. Actually, it can be some of the best conditions to trade in, because it's very simple. You know where your levels are. You know, we can see a massive level of support here, and we know that there's some good resistance. If we get above 132, then it potentially could go all the way back towards this kind of, you know, 133.5 back towards 134. And I would say that double top to me looks like it's going to be in place for a while. Added to that, obviously, come September then, things could go really crazy again, because it will obviously be determined by, you know, the Fed actually doing tapering or actually not doing tapering. But August could be fairly quiet. I remember as well, next week is a massive week for the markets. We've also had that Fed meeting, even though it could be quite a quiet meeting, but we've got a ton of stuff, lots of economic data releases, and also the non-farm payrolls to round the week off. and the ECB meeting, of course. But this week, tomorrow is going to be a big day for the euro because we get that first reading of July PMIs. Remember, in Europe and China, actually, they tend to release them preliminary reading in the third week of every month, and so that's going to be really important. The euro has reacted to PMI data in the past. We would expect it to do so again. Again, the market's expecting a pick up to 49.1 from the 48-ish level. It's still in contraction territory, but it suggests the economy is stabilizing. That's what the market wants to see. That could be euro positive. Could be what gets us above this 132 level. And, we would say that there is probably an even chance of it pushing higher. Euro dollar, because also, we do tend to think that even though the dollar may stabilize a bit today, at the end of the day it could grind lower, as we said, into payrolls, because there is some expectations or just a little bit more uncertainty now around tapering. Okay, the other thing I want to show you, of course, is Aussie. And the reason why is that it's a massive level or week for the Aussie. Tomorrow, sorry, I just had to take a quick sip of water. Tomorrow we get the Q2 CPI data, and so compared to everywhere else, Australia releases their CPI. They release their CPI data on a quarterly basis rather than a monthly basis. So it's really, really important. Basically, the RBA's target rate is between 2 and 3%. And the market expects a drop in inflation, so it's the weighted trimmed mean. That's the inflation you need to look at. Don't worry too much. It basically just means it's kind of core inflation. I know it's a bit of a mouthful, but they're expecting that to fall to 2.4% from 2.6%. Obviously, any downward or any kind of downward pressure on inflation there could really open the door to a rate cut in August. Now, interestingly enough, the rate expectations for Australia are only pricing in for quite a small, only pricing in about 17 basis points of cuts for August. So if we do get weaker than expected inflation, then we could see a big reversal, a big rush to price in, this August cut. So we could see a big drop in Aussie. The first thing to look at is probably this level here, 91.5. Remember, we're currently trading about 100 pips away from that. And then obviously this low here. So at 90, we have been sub 90 this year. We got to 89.99 on the 12th of this month, so Friday the 12th. I was at a wedding that day, funnily enough. But we saw a huge wave of buying interest that really propped that level up. So, that's key support. But obviously, a rate cut's a different thing, and the market had been kind of moving away from the prospect of rate cuts. Now, it's not only going to be inflation tomorrow for Australia that's going to be important. It's also going to be the China PMI data, the flash reading of China PMI for July as well. Again, that's expected to remain really in the doldrums, about 48.3 from 48.2. So do watch out for that. Again, weak inflation combined with weak China PMI could weigh heavily on Aussie tomorrow, and it's released at 2:30 a.m. London time. So again, it could be, a very volatile morning. Now, I just want to just show you something. Bear with me one moment. Okay, bear with me one moment. Just pulling up a chart for you guys. Now, there's been one notable outperformer this week. Can anyone think what it is? Can anyone think what it is? No? Okay, it's gold. Gold's been a very big performer. Yeah, Pan, you got it. Oil and gold, indeed. I will talk about both of those. But gold has made some fantastic moves, and I think because it's been so much in the doldrums of late, well, for most of the past year, the gold move is really being recognised now. We've got above that 50-day moving average at 1330. We are finding a bit of stickiness here, actually, and we're around this level. We got above it earlier. We're currently trading just below it now. But really, jumped through 1300. That opens the way for a move back to kind of the 1400, 1420 levels, which is this 100-day moving average. Now, again, the reason fueling this move are a couple of things. Firstly, gold was looking incredibly oversold. Let's just bring up gold on this chart. It was looking incredibly oversold. Let me just get the RSI up. As you can see, this is the weekly chart. Look, it looked terrible, pushed higher. And then obviously we've seen, like, a couple of good weeks, some positive weeks, which suggests that, made a nice bottom there around about that 1200 level. And we're now up over $100. What is driving this? Well, obviously it could be expectations of QE from the Fed, and the fact that, there's likely to be loose global monetary policy for some time to come. It could also be down to, the fact that, as I said, its positioning, it started to look, very, kind of cheap. So it brought in physical demand. We need to wait to see about the physical issues. But that has been important. Now, silver, Ray is saying silver break the big figure. Interestingly enough with silver, it's, and it has done this before. Let me just make this chart small so you can see the two of them together. This is just spot silver, just to show you again on the candlestick chart. Yes, broke above that 20 level, very, very, absolutely true, but really has been a bit of an outperformer, been a massive underperformer compared to gold, and you can just see that on the two charts. 2098, so just below that 21 level, massive resistance, 50-day moving average, so definitely worth watching that on the silver side of things. Obviously, silver could be quite sensitive over the next kind of 24 hours. It's an industrial metal, so it is very sensitive to global growth figures. So we get those July readings of PMI from Europe and China. That can have a big impact on silver and what it does. Again, with gold, let's just look here. And when we're on the daily chart, that 50-day moving average, as we said, just stimulating things for now. But if we continue to see that kind of grind lower in the dollar, then we think we could get back above to that 1400 level, maybe even back to 1450, which is another kind of moving average support resistance level there. As you can see, it's the red line in this chart. This is the 200-day, by the way. So there could certainly be some further upside. Right now, there isn't anything. This just suggests like a normal pullback, really, around about that 1330 level, and it doesn't suggest to us that we're falling lower any time. I'd probably want to see bearish engulfing or something before I thought that this 1320 or 1330 was the high for now. Paul, you've said, how do you think gold will go? Last week there was much forecasting regarding pending fall in gold. Yeah, exactly. Gold. In the long term, we think it's going to fall. So our medium-term outlook has not changed. But we do think that this is a correction. It's a correction that was driven by Bernanke. Obviously, we didn't know that this time last week. So that's one of the reasons why gold could, is having this correction. We think it could potentially go back to the 1400 level. As I said, if we get above there, 1450, that 200-day moving average could really stimulate the bulls. Because we still think that, at the end of the day, the Fed are going to start tapering, and inflation is still going to be low for some time. The fundamental drivers of gold are not necessarily there, but that doesn't mean that we can't have a nice recovery. We've seen it in the past. We saw it here, for example. We kind of moved sideways for a while, earlier at the end of last year, and it looks like we're doing exactly the same again. Now, again, we're not looking to get back to 1800 or anything like that, or 1900. Just a nice, steady recovery. And that, again, has been driven by Bernanke and also driven by this kind of grind lower in the dollar. And the fact the market is just squaring up some positions. Emerging markets, they're still in a bit of trouble. So the physical demand story for gold still a little bit problematic in the long term. So, we still see us kind of falling lower. Rocco, yes, good point. Kiwi as well. Let's not forget that. Tomorrow evening London time, so 10 o'clock London time, we get the New Zealand RBA meeting. No change expected, but it could be fairly hawkish. Watch out for that. From a technical perspective, on a daily level, on the chart, here we have been stymied at 80. We were here before, kind of like about a month ago. Being stymied at this 80 level yet again, that's a massive level of resistance. If we can get above there, then it really opens the way pretty much all the way back to this 82 level. In the slightly longer term, I mean, this is a short-term chart, as you can see, just pulling back here a little bit, but very, very good support up all the way down to 79.50. That could act as a fairly good buying zone. And then, obviously it's going to be dependent. We think that we're going to probably hover around this 80 level. It's going to be difficult to see any real kind of momentum building ahead of that RBNZ meeting on Wednesday night our time, or Thursday New Zealand time. Sorry if that's what you're going with. It's going to be hard to see us kind of get above that level before the meeting. Obviously, then you have to digest the meeting. Any type of remotely hawkish statement from them, and we could push higher towards that 82 level. Obviously, I would say that the risk is just tipped right now. The slightly bigger risk is that they're not as hawkish as expected, and we fall back lower. And then that could see us getting below that 79.50 level. We could get back to just below 79, which is the lows from kind of the end of June, and then maybe even down to that kind of 78.50 level. So from a shorter term perspective, we're very much kind of range trading now, we think, into that meeting of 50 pips, 79.50 on the downside, 80 on the upside, and then just watch what they say. You can't really second guess central banks at the moment because they're in very kind of complicated policy territory. So it's worth just kind of digesting what they say and then reacting on the back end of that. Okay, anybody? Just one last, I'll just run through one last thing here with Aussie Kiwi. Again, if we get like a hawkish new RBNZ, but potential for a rate cut from New Zealand, then we could kind of fall back lower again. As you can see, Aussie Kiwi has really run into, it's been in trouble really for most of the last kind of 6, 7, 8 months. It's struggling. It's consolidating a little bit now. Any strength towards kind of 115.80 or 115.95, sorry, which is the 55-day moving average, could be used as selling pressure, and we could get back to 115 over the next kind of week or so. That would be kind of our take, is looking for a move back to 115. We're not, we're not in kind of oversold territory yet, as I said. We're kind of in consolidation territory. Interestingly enough, there's some key that's quite a bit of a nice kind of, medium-term trend line there. Obviously, we're testing it. And if we get below it, so below that kind of 1580 level, could really see us get back to 115. I don't necessarily think there's going to be a huge amount of movement. We are still quite low on a historical basis. This is just it. That's the hourly. We're very low on a historical basis, but, certainly getting back to that kind of 115 level, I could see that happening. I just did look. Oh, sorry, yeah. So got the Aussie Kiwi look. Anyone else got another question? Happy to take one more before I have to go. Hopefully those technical looks were helpful to you. Oh, dollar yen. Okay, Paul. Yeah, no, that's good. Dollar yen's been really interesting. I sent out a note about it. As I said, you can always check our research as well. Please do, actually. I'll just show you when you can get it now. You can get a lot of this is just a link to all our research by kind of all 4 of us analysts. In terms of dollar yen, as you can see here, no, you can't. Let me just bring it up. Dollar yen has been, it had a bit of a scare yesterday, fell through the 50-day moving average, but we've managed to climb above that. Again, some very, very good buying interest waiting around about that 99 level, just ahead of that 99 level. And the fact that we've managed to get back above the 50-day moving average suggests yesterday was a bit of a false break lower. It was moving, it moved, the yen strengthened on the back of these LDP elections. Maybe, some slight, or maybe 2 things could have been driving it. Some slight fear that, will Abenomics be able to persist? Will he continue going with it? And then the other, now that he's got a mandate, could he just drop it? The other thing, of course, is, is this actually good news? Great. There's been political unity. Let's buy the yen. So it's acting more as a growth currency rather than a safe haven. Because remember, usually safe havens, they fall in good situations. So what we've seen is, just the dollar, really kind of struggle to digest what that information means. Added to that, we do have the CPI reading later on this week. We get CPI, which will come out, when does that come out? Friday morning, our time. They're expecting another pickup in core CPI, so from 0% to 0.3%. So still a long way from that 2% inflation target. It certainly supports more QE, but it suggests they're moving in the right direction. And that could be yen negative because, again, as I said, it supports more QE. That, this is going to work if they just throw enough money at it, then they can get to that 2% inflation target. So that's kind of the the key thing to look at there. Obviously on the upside, 100, huge level, big psychological level. 101.10 is capping the upside in the short term. And then you get to this kind of, just below 102 level, 101.70, were the highs from very early this month. So that's kind of the key thing there. Okay, everyone, we've just run over time. Thank you so much for joining. Good luck trading this week. There's a lot going on. Thank you for your kind words. Please do join us next week. I know it's summer holiday times and some of you may be on hold, but thank you so much. You guys were great. And good luck trading this week. Thank you.